You are scrolling through your phone on a random Tuesday night, watching the stock market red lines take a massive dive on the news. Your stomach does a little flip, but then you smile. You think to yourself, this is it. This is the big moment I've been waiting for. You have $10,000 sitting in a basic savings account, just waiting for this exact crash so you can finally buy in at the absolute bottom. It feels like the ultimate chess move. You are being patient, you are being smart, and you are avoiding the risk of buying when things are expensive. But what if that patient strategy is actually costing you a fortune? It feels completely logical to wait for a discount. Why buy today when it could be cheaper next month? Except, the math tells a completely different story. Today, we are going to look at the actual numbers behind waiting for a market crash versus just putting your money to work right now, so you can stop leaving wealth on the table. If you want to build a real financial safety net without losing your mind over daily market headlines, you are in the right place. I'm Jack, a guy who spends way too much time analyzing spreadsheet data and looking at historical charts when I should probably be touching grass. If you are tired of feeling like you are running on a financial treadmill, hit that subscribe button so we can figure this out together. Here's the thing about waiting for the perfect moment. It is an absolute trap. We have been conditioned to believe that successful investing is all about timing, like we are some kind of Wall Street wizards who can predict the exact day the market hits rock bottom. We see the dramatic headlines, we hear the pundits shouting on television, and we naturally freeze up. We tell ourselves that we will start putting our money to work just as soon as the dust settles. But the dust never really settles, does it? There is always another crisis around the corner, always another reason to hesitate, and always another warning that the big crash is coming. So your money just sits there. It sits in a regular account, losing purchasing power to inflation every single day while you wait for a green light that never actually arrives. You feel like you are being cautious and responsible, but in reality, you are paying a massive, invisible tax for your hesitation. This is where it gets really interesting. Let's look at a real-world scenario with two different people over a 20-year period to see how the numbers actually play out. Imagine the first person, Sarah, decides to save $200 every single month. And she immediately puts it into the market on the first day of the month, no matter what is happening in the world. She doesn't look at the news, she doesn't check the charts, she just automates it and goes about her life. Now imagine the second person, Mark. Mark decides he is going to be clever. He saves that same $200 a month, but he lets it pile up in cash. He waits, sometimes for years, until the market drops by at least 10% from its peak. And only then does he dump all his accumulated cash into the market at that discounted price. You would think Mark wins by a landslide because he only bought the dips, right? Well, historical data shows that Sarah ends up with significantly more wealth than Mark even, though Mark timed his entries perfectly during every single crash. Because while Mark was sitting on a pile of cash waiting for things to get worse, Sarah's money was already working, compounding, and earning dividends year after year. Here's what most people don't realize about the psychology behind this behavior. Our brains are hardwired to avoid pain at all costs, and losing money feels twice as painful as winning money feels good. When you see the market going up and up, you experience a strange mix of fear of missing out and a deep dread that you are buying at the absolute peak. Your brain tries to protect you by saying, let's just wait for a pullback. This is a psychological defense mechanism called loss aversion. We convince ourselves that we are waiting for a bargain, but what we are actually doing is hiding from uncertainty. We think we can outsmart a system built on decades of global economic growth by using our personal intuition. It gives us a false sense of control over an unpredictable world, making us feel like active drivers of our financial destiny when we are really just passengers, paralyzing ourselves with overanalysis. 2. Break out of this cycle of waiting and wasting time. We need a concrete framework that takes our emotions completely out of the equation. I call this the consistent engine framework. It is a 3-step system designed to automate your growth, so you never have to guess whether today is a good day to invest. The first step of the engine is called baseline automation. You need to pick a realistic amount of money from every single paycheck of it, if it is just $50, and set it up to move automatically the day you get paid. This money leaves your main account before you even have a chance to see it, touch it, or think about it. By automating the transfer, you remove the daily decision-making process entirely. You no longer have to ask yourself if the market is too high or too low, because the machine is doing the work for you on a fixed schedule. The second step is what I call the noise blackout. Once your automation is running, you have to actively stop consuming daily financial news and clickbait headlines designed to make you panic. The media thrives on creating urgency and fear because panic drives clicks, but panic ruins long-term financial plans. If a headline says a massive crash is imminent, you have to remind yourself that nobody actually knows the future. Your job is to look away from the daily scoreboard and focus entirely on the horizon, trusting that consistency wins over decades, not days. The third and final step of the system is the dividend reinvestment loop. Whenever the investments you hold pay out small percentages of profit, you do not take that cash out to spend it. You set your account to automatically use those small payments to buy more shares immediately. This creates a snowball effect where your money starts producing its own mini-money, which then buys more assets, accelerating your progress without you ever having to inject extra cash from your salary. Think of your financial journey like building a snowball at the top of a very long hill. If you want a massive, unstoppable snowball by the time you reach the bottom, you need to start rolling it immediately and keep it moving continuously. Every day you leave your money sitting on the sidelines in cash is a day you are standing at the top of the hill, holding the snow in your hands, waiting for the perfect weather conditions to start rolling. Meanwhile, the person who started rolling their tiny, imperfect snowball on a warm, rainy day is already halfway down the mountain, and their snowball has grown 10 times larger than yours just because it had more time to gather mass. The texture of the snow doesn't matter nearly as much as the length of the hill. Now, you might be thinking, Jack, this sounds fine in theory, but what if I start investing today and the market literally crashes tomorrow morning? That is a totally valid fear, and it feels terrifying to think about losing a chunk of your hard-earned savings immediately. But here is the perspective shift you need. If you are an everyday earner with 10, 20, or 30 years ahead of you, a market crash right after you buy is actually a massive blessing in disguise, because your automated system is going to keep buying next month and the month after that, which means you will automatically start buying shares at a massive discount without having to time it. Over the long run, those cheap shares you buy during the crash will pull your average cost down, setting you up for an even bigger surge when the economy eventually recovers, as it always has historically. Let's quickly review the steps of the consistent engine framework so you can lock this strategy into your brain. First, establish baseline automation to move your funds before your emotions can interfere. Second, implement a noise blackout to shield your mind from panic-inducing headlines. Third, activate the dividend reinvestment loop to ensure every dollar your money makes is immediately put back to work. Here's what most people don't realize. When they are caught in the trap of waiting for the perfect moment, wealth isn't built by outsmarting the system or guessing the future. Wealth is built by having the emotional discipline to be boring, consistent, and patient while everyone else is panicking. You don't need a degree in finance or a massive inheritance to build security for your future self. You just need to get started today with whatever you have and let time do the heavy lifting for you. Stop waiting for the perfect drop, because the cost of waiting is almost always higher than the cost of just getting started. Thank you so much for hanging out with me today. Go ahead and hit that subscribe button if this helped lower your financial anxiety a little bit. And I'm curious about something. Have you ever held back your savings because you were scared the market was about to crash? Let me know in the comments below.